OG John AG here, and I need you to stop whatever you're doing right now. Silver just hit $125 per ounce on the Shanghai Futures Exchange. Let me say that again. $125. The Shanghai Premium over COMEX just exploded to $15 to $17 per ounce. We are 2 hours into Monday trading in Asia, and silver is already up $6 on the day. America hasn't even woken up yet. Before we break it down further, if you want real-time updates and what I'm building next for real community members, join the WhatsApp community, link in the description. It's 100% free. Approval takes a moment to keep out scammers and bots. If anyone asks for payment, block them immediately and protect yourself. If this content is delivering real value and helping you think independently, drop OG or Real OG John AG in the comments. It means a lot to me and the team. We use it to gauge who's actually here for the truth. If it doesn't resonate, no hard feelings. Plenty of mainstream narratives out there. I'm building for committed, clear-thinking people only now. Back to what's unfolding. Silver set a record high approximately 28,000 yuan on the Shanghai Futures Exchange, and that price action is now lifting COMEX silver toward $110. This is not a typo. This is not hype. This is the physical market screaming at the paper market that something fundamental has broken. Friday afternoon, we warned you silver was going to rip faces off this week. We're only 2 hours in, and it hasn't disappointed. But here's what you need to understand. This isn't just a rally. This is a signal. A $15 to $17 premium between Shanghai and COMEX is not normal volatility. That's a structural fracture in the global pricing mechanism for silver. Let me walk you through what's happening right now, why it matters, and what the immediate implications are for anyone holding physical metal or watching these markets. First, the mechanics. When Shanghai is paying $125, COMEX is trading around $109 to $110. That $17 gap represents pure arbitrage opportunity. In theory, you should be able to buy silver on COMEX, ship it to Shanghai, sell it, pocket the premium minus shipping and insurance. Except that's not happening fast enough, and that tells you everything. Physical silver is not moving freely. Either it's not available in the quantities needed, or the logistics can't keep pace with demand, or both. This premium didn't appear overnight. It's been building for months as China has tightened export controls on critical metals, stockpiled strategic resources, and watched Western inventories drain. The Shanghai Premium is a price discovery mechanism, and right now it's discovering that physical silver in Asia is worth significantly more than paper contracts in New York or London. Look at the COMEX registered inventories. We've been tracking these for months. Registered silver, the metal actually available for delivery against futures contracts, has been trending down while open interest remains elevated. Every time we see a delivery squeeze, a few more million ounces get reclassified or withdrawn. Now Shanghai is effectively bypassing COMEX price discovery entirely and saying, we'll pay what we need to pay for physical metal. The technical picture is equally striking. Silver blasted through resistance at $105 like it wasn't even there. The RSI on shorter time frames is deep into overbought territory, but on the weekly and monthly charts, we're still in the early stages of what looks like a major breakout from a multi-year base. The volume accompanying this move is legitimate. This isn't a low liquidity spike that gets reversed in the next session. This is institutional and sovereign level buying. Here's the part that should concern anyone still believing COMEX sets the global price for silver. If Shanghai can sustain a $15 to $17 premium, it means the physical market in the world's largest manufacturing economy has decoupled from Western paper pricing. That's not a temporary dislocation. That's a structural shift in how silver gets valued globally. China is the largest consumer of silver for industrial applications: solar panels, electronics, EVs, 5G infrastructure. If Chinese buyers are willing to pay $125, they're either desperate for supply or they know something about future availability that the West doesn't. Now let's connect this to the macro backdrop. We're in the middle of a global race to secure critical materials. Silver isn't just money. It's not just a speculative asset. It's a strategic industrial metal with no substitute in most of its applications. You can't build solar panels without it. You can't manufacture high-efficiency electronics without it. The energy transition that every major economy is committed to requires silver in quantities that current mine supply cannot meet. And here's where the geopolitics gets spicy. China implemented export controls on critical metals last year. The United States is pushing reshoring and onshoring of manufacturing. Tariffs are being weaponized. Supply chains are fragmenting along geopolitical lines. In this environment, a $15 to $17 premium in Shanghai isn't just about supply and demand in the traditional sense. It's about strategic stockpiling. It's about ensuring domestic supply in a world where you can't rely on global markets to deliver when you need them. The mid-video reveal here, The thing that should reframe everything we just discussed is that this Shanghai premium spike is happening while Western institutional investors are largely absent from the silver market. Hedge funds, pension funds, sovereign wealth funds outside of Asia have been underweight precious metals for years. If this Shanghai price action forces a reassessment, if it triggers FOMO or strategic allocation shifts in the West, we're not talking about a $15 to $17 premium anymore. We're talking about a global repricing of silver across all markets. Let me paint the scenario. Asian buyers are paying $125. COMEX is at $110. Western funds start buying futures to capture the arbitrage or to hedge supply risk. COMEX inventories can't meet delivery demand. Premiums on physical metal in New York and London start climbing. Backwardation, where spot prices exceed futures prices, becomes persistent instead of occasional. At that point, the paper market loses its credibility as a price-setting mechanism, and we enter true price discovery based on physical availability. Now, I know what some of you are thinking. John, this could reverse. This could be a short squeeze. This could be a liquidity event that gets unwound when Asia closes and New York opens. And you're right to think that way. That's the discipline we need. So let's talk about the bearish case, the resistance, the reasons this might not hold. First, if this is purely a Shanghai-specific squeeze driven by a few large buyers or a technical default situation on the Shanghai Futures Exchange, the premium could collapse as quickly as it appeared. We've seen flash premiums before in other commodities when a single contract or warehouse has issues. If Shanghai metal starts flowing back into global markets, that $17 gap closes fast. Second, the paper markets have absorbed massive shocks before without breaking. COMEX has tools. They can raise margins, they can halt trading, they can settle contracts in cash if physical delivery becomes impossible. The concentrated short positions we've tracked via COT data, those players have deep pockets and regulatory connections. They've managed to suppress silver rallies for decades. Don't underestimate their ability to cap this. Third, if this move is too fast, it triggers profit-taking and technical selling. Traders who bought silver at $90 or $95 are sitting on massive gains. The temptation to lock in 20 to 30% profits in a matter of days is real. That selling pressure could stall the rally even if the fundamental shortage is real. Fourth, macro conditions could shift. If the dollar suddenly strengthens on unexpected Fed hawkishness, or if risk-off sentiment hits global markets, silver could get sold along with other risk assets. We're in a fragile macro environment. Geopolitical shocks, credit events, liquidity crunches, any of these could derail a commodity rally regardless of the underlying supply-demand fundamentals. And finally, full risk disclosure. Silver is volatile. If you're not prepared for a $20 swing in either direction over the course of a week, you shouldn't be in this market. If you're over-leveraged, if you're trading on margin, if you're using money you can't afford to lose, this is not the time to chase a rally. The risk of a violent correction is real, but here's why the bullish case, despite those risks, is escalating. The Shanghai premium isn't happening in isolation. Look at what's been building for months. COMEX inventories declining. London Metal Exchange inventories flat to down. Shanghai Gold Exchange premiums for gold also elevated. Central banks globally continuing to buy gold at record pace. Industrial demand for silver outpacing mine supply by a widening margin every year. Geopolitical fragmentation making cross-border metal flows unreliable. This isn't one data point. This is a convergence. The $15 to $17 Shanghai premium is the visible symptom of a supply crisis that's been developing beneath the surface. And if China is willing to pay that premium, it signals they believe availability at any price is more important than waiting for cheaper metal that might never come. The solar build-out in China alone requires hundreds of millions of ounces of silver annually. The electric vehicle transition is in its early innings. AI data centers need silver for high-performance computing. Military and defense applications are non-discretionary. These aren't speculative demands. These are structural, non-negotiable uses that don't stop because the price goes up. And here's the kicker. If COMEX tries to suppress the price while Shanghai is paying $125, the arbitrage flows will drain COMEX inventories even faster. You can't maintain a $17 pricing disconnect for long without physical metal moving to the higher-priced market. And if COMEX doesn't have the metal to deliver, the whole paper pricing structure starts to crack. We're potentially watching the early stages of a global silver market reset. The days of COMEX and LBMA setting the price, while Asia and the physical buyers just accept it, might be ending. Shanghai is effectively saying, we'll pay what we need to pay, and if the West wants to play paper games, fine, but the physical metal is ours. For those of you holding physical silver, this is validation. The premiums you've been paying over spot for months, the $8, $10, $12 premiums on coins and bars, those weren't dealer gouging. Those were the market trying to tell you that physical metal is worth more than paper. Now Shanghai is confirming it at the institutional and sovereign level. For traders, the setup is both opportunity and danger. The momentum is undeniable, but the risk of a sharp pullback is real. If you're long, consider where your stops are. If you're looking to enter, don't chase the top of a 15% move in a day. Wait for a consolidation or a pullback to support. Discipline beats FOMO every time. For stackers, the question is whether premiums on retail products follow Shanghai higher or whether you see a temporary dip as dealers get squeezed. I'd expect premiums to stay elevated or rise further if this price action holds. Physical availability is the constraint, not paper price. 3 key takeaways. 1. A $15 to $17 Shanghai premium over COMEX is not normal and signals a structural supply issue. 2. If this price disconnect persists, it challenges the credibility of Western paper markets as the global pricing mechanism for silver. 3. The convergence of industrial demand, geopolitical stockpiling, and draining inventories is creating a supply crisis that higher prices alone might not solve quickly. The unresolved tension. We don't yet know if COMEX and LBMA will acknowledge this pricing reality or if they'll try to suppress it through margin hikes, cash settlements, or regulatory intervention. We don't know if Western institutional money will pile in or stay on the sidelines. And we don't know if Shanghai's willingness to pay $125 is a short-term squeeze or a permanent repricing. Watch the registered COMEX inventories this week. Watch the premiums on physical coins and bars. Watch whether London and New York prices start converging with Shanghai, or whether the gap widens further. This is not the time to be complacent. Do your own research. Verify everything. Understand your risk tolerance. And if you're holding physical metal, understand why you're holding it and at what price you'd consider taking profits, if ever. This is history unfolding in real time. The battle between paper pricing and physical reality is reaching a critical inflection point. Stay sharp, stay informed, and don't let anyone tell you this is just another rally. Invest with logic, not hype. OG out and about.